Do we expect more? Yes, I certainly do expect more, but I do not buy into the scenario of look at the refinancing profile. I've looked at all these loans coming to maturity, 10 billion next month, blah blah blah. We can all read the articles. The fundamentals are that doesn't mean 10 billion of assets coming to the market. I think the themes of the slow trickle, I think is probably is the most likely scenario. I do think, however, that the transaction flow currently is multiples of what it was 2 years ago. That may not be many multiples, but that's multiples of what it was 2 years ago. And I think as you look forward 2 years, you're probably looking at single-digit multiples of what we're looking at today. That still means a slow deleveraging process because the pool of problem is very significant.
I would just also add there's a big difference. One of the interesting things are the CMBSs, which are liquidating where it's very difficult for the servicers to actually extend some of those loans. And so on the non-single asset or small asset pools, which were securitized, where you have a lot of assets across multiple classes in a complicated CMBS structure, that actually we're starting to see assets coming to market and being sold by insolvency administrators. And sort of it's very different from a balance sheet lending situation where you've really got somebody on the other side of the table to negotiate with. So that actually will sort of run its course in a process. And as a buyer, it's interesting because you know that there will be a transaction as opposed to spending lots of money on something which won't transact. So that's kind of maybe one of the interesting disintermediations in the market where there is activity that we're seeing. Picking up.
Yeah, I mean, we're seeing a bit of that in, but I think once you get to the sort of tail maturity date,
right,
the control passes from the controlling note holders back to the A note holders, who are going to go straight for disposal. So we've seen situations where the A note holders are becoming more entrenched in their position because they know they can wait until the tail maturity date and then they will control everything in a sense. So I mean, that happened in a sense with the Uni Invest thing where control went back to the A note holders.
I mean, we acted for Patron on that, and I think that probably doesn't apply to the conduits you're referring to, but for the owner issue, I think that's the solution.
Yeah.
Because fundamentally, for a number of people in the room, coming back to a situation where there is no debt, the best debt you're going to get is probably the one that's already in.
right.
So if you can put it in market-facing terms and somehow satisfy and convince the incumbent lenders that they can stay in, I think everyone would probably agree that's probably the easiest way. Actually, it's probably easier to do it this way than try and convince a bank to buy a big bunch of secondary property in any European jurisdiction.
Just on the point, Richard, of what's coming to the market, sort of as a general observation, around this time of year, sort of at the beginning of Q4, for the last 3 consecutive years, market observants, whether it's the Big Four or the buy side, have sort of started predicting that the next year would be the year of the flood. and I'm guilty of having participated in sharing those views. So now, recently out are several sort of market surveys from your colleagues, as an example, or your peers rather, where the buy side of the industry, some probably in this room, sort of predict that 2013 is going to be the year of the flood, and it's sort of becoming ever more difficult for myself to agree to that because we've been proven wrong, and it's very unlikely in this economic climate that will actually happen. In those same surveys, of course, and they are colored by the way that they are conducted and who's participating and so on. They're a little bit self-serving. It's interesting to note that both sellers and buyers are being asked whether they are participating in bilateral discussion about loan portfolios or multiple party auctions. And on the buy side, by far the majority says that they are participating in bilateral discussions, but on the sell side they say that by far is the multiple auctions. And that just sort of statistically doesn't really add up. But the surveys are worth what they're worth, and they're very interesting, so I recommend you have a look at them. But if you just look at the reality, and if you take, let's say Ireland as a sort of the canary in the coal mine, and as maybe as a small example of what could happen in the larger European market, less than a year ago, there was basically very limited trading of portfolios, except with a few exceptions of some US assets that had been divested more aggressively from AIB and others. The Troika came out earlier this year with a sort of whip on their back and demanded about 75 to 100 billion deleveraging of that sector within a very short time period. This sort of target was before end of year 2013, which can be said is unrealistic. Having summarized the transactions that have come to play just in the last 6 months and have been actually sold out of the banks or are now in play, like the most recent Lloyd's portfolio coming out with a deadline just yesterday or the day before, that sort of sums up to 5.5 billion. So that's not much towards a 75 to 100 billion goal, but that's still 5.5 billion of distressed loans being traded at a very deep discounts to the usual suspects that come and bid for them, that were not in play just 6, 8, or 12 months ago. So if you think that's something that is sort of leading the market, then maybe we'll see it coming. At the same time, in Spain, the Spanish legislature just passed a new legislation on incorporating a bad bank infrastructure for the whole of the banking system about 2 weeks ago. So it sort of seems that they might be moving there as well, but probably quite slowly.